On today's show, Harley-Davidson says it is developing an electric motorcycle. The Russian car market looks like it's starting to recover, and why Wall Street values Tesla more than General Motors. All that and more coming right up on Autoline Daily. This is Autoline Daily, the show for enthusiasts of the automotive industry. And we start out today looking at the global automotive market for new car sales because we're seeing two notable developments. First, car sales unexpectedly fell in China last month. They were down 3.7%. The market has softened ever since the government raised taxes on small cars. Analysts still think the market will grow this year, but at half the rate of last year. And that could have a sizable impact on automakers and suppliers. Meanwhile, new car sales shot up nearly 7% last month in Russia. The Russian market was crippled by economic sanctions and a weak economy, so this increase in new car sales is definitely a sign that things are improving there. Even so, April sales were not as strong in March, so the recovery is still very fragile. The top-selling brands in Russia are Lada, Kia, and Hyundai. Harley-Davidson is jumping on the battery bandwagon. A few years ago, the company introduced an electric motorcycle prototype called Livewire. Now Bill Davidson, the VP of Harley-Davidson Museum and the great-grandson of the company's founder, says they have a range of electric motorcycles in their product plans. While that's probably disappointing news to some Harley enthusiasts, Davidson says the company is developing a signature noise for its electric bikes that sound like a jet fighter. Interestingly, Davidson believes that autonomous cars will help motorcycle sales because driving enthusiasts will want something they can drive themselves. Coming up next, Nissan does a very nice thing for senior citizens in Brazil who are about to lose their license.
Autoline Daily is brought to you by Bridgestone Tires, your journey, our passion. Dow Automotive Systems, advanced materials that deliver better results. And by Lear, a global leader in automotive seating and electrical systems.
I believe that driving a car is one of the greatest freedoms we have in life. But as we get older, our sight, hearing, and reaction times can start to go, and there just comes a time where we're not safe to drive anymore. Well, before that time comes, Nissan wanted to send a few senior citizens in Brazil out with a bang. You see, in Brazil, at 65, you must pass a physical test every 3 years to keep your license. So Nissan hooked these folks up with a ride to a racetrack where they got to experience the high-performance GTR. It started with them getting thrown about in the passenger seat while a professional driver whipped around the track. But after snapping a few photos of their stunned and surprised faces, it was their time to get behind the wheel. And from the looks on their faces, it was something they'll never forget, even after their licenses are taken away. Well, this is not good for FCA. The automaker is recalling more than 1.25 million Ram pickup trucks around the world to fix a software problem. An error code may keep the side airbag and seatbelt pretensioner from deploying in a rollover accident that's caused by a hard underbody impact. The issue is linked to 1 death and 2 injuries. Affected vehicles include 2013 to 2016 Ram 1500s and 2500s, and 2014 to 2016 Ram 3500 pickups. The price-to-earnings ratio is a way to measure how much value the stock market places on a company. The average PE ratio in the S&P right now is 22. That is, for every $1 in earnings per share a company generates, the market will pay $22 for their stock price. Ford and GM are under enormous pressure to boost their PE ratios. But guess what? Every car company in the world has a lousy PE. The point is, the stock market just does not value traditional automakers very much. And Tesla is not on this list because it does not have a PE ratio. It doesn't have any earnings. Tesla loses money. Coming up next, Wall Street auto analysts explain why Tesla is valued higher than Ford or GM.
We set up an obstacle course to demonstrate Bridgestone's Blizzak WS80 tires.
Whoa!
The advanced engineering of our tires helps you stop safely on ice. In fact, they stop 33% faster than an all-season tire.
Wow. Yeah, we're not done yet.
Despite bleeding red ink and never posting an annual profit, Tesla is now valued more highly than GM or Ford. So what gives? On Autoline this week, John sits down with 3 Wall Street auto analysts and hears their insight into why Tesla is valued so highly.
I don't know. I certainly don't understand it, having spent my life following, slow-growing, capital-intensive businesses, which they are. I mean, eventually they have to, they're an auto producer, they're going to have the same kind of balance sheet as an auto manufacturer. I mean, they're not going to own the world. So.
Yeah. I mean, I think when you look at it, they've done some great stuff with their vehicles. Over-the-air updates, the fact that it's essentially a phone platform instead of a car platform that changes over time. There's some really interesting things that they've done that I think have exhibited to the industry and investors where the industry might be in 5 to 10 years. But their ability to execute on pure production has been subpar at best relative to the core companies, and you still need the actual physical car and do it profitably and to generate cash flow to support the business going forward. So there's a huge hope trade that's going on here that is years out, and the more that they grow their volume, the more they become an auto manufacturer, and the more the valuation makes less and less sense. So it's a very curious thing that's going on right now, but they have one very unique competitive advantage, right? And that's essentially no cost capital, right? They can raise capital and when they need to. There's not a lot of questions asked, and you have 10 cent that just piled in. So if you look at this recent run in the stock from the 240, 250 range to above 300, everybody is now a little bit more comfortable that as much as cash as they burn, they can always keep going and get it. And that's a risky trade to make, because cost of capital can go up and availability can come down, and then the story ends.
And their metrics on how they're valued aren't the same. So you have no cost capital with a completely different set of metrics that say, oh, it's worth more. Or whether you're a solar company or you're a battery company or you're an automaker, we look at it and say, well, there's financial physics that an automaker must adhere to that they don't have to. And I've said, their competitive advantage is that they lose money and burn cash, where all the other automakers basically say, why would we do that? So it looks like Tesla can do things that other automakers can't, and all that is purposely lose money, where it's not that the product is better or the technology is better, it's just that the other automakers, and you can't convince me that BMW can't write a check and do exactly the same thing, if not better, with the financial strength, the design, the history of the company. It's just that they look at that segment and go, why would I do that? It's a money loser.
And for more perspective about how the investment community views the auto industry, you can watch that entire discussion right now on Autoline.tv, or you can find it on our YouTube channel. That wraps up today's show. Thanks for watching. Have a great weekend, and we'll see you right back here again on Monday.
Ward's is the industry leader for news, data, and analysis. That's why companies across the globe subscribe to our premium service, maybe even your own. Log in for subscriber access now. Check your company's intranet for details, and rely on wardsauto.com to keep you informed.